Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So we're always talking about investing in great companies, stocks that have, cash flow, they do pay some dividends, they have a great balance sheet, they have a moat or a competitive advantage. All of these things are amazing, but sometimes it's just you need to know what these companies actually look like. And that's what we're going to do today. So when we talk about the stock market, especially in the US stock markets, right, there are three types. So we're looking at the S&P 500. So the S&P 500 basically consists of 500 biggest companies in the US market. So 500 of the biggest companies in the US. That's what it is. It's down right now almost 10% year to date. Then we will look at the Nasdaq 100. This is 100 companies, mainly tech companies and biomedical science tech companies, biotech and tech companies. These are very kind of speculative growth companies, okay, and they're down about 15%. And then finally is the Dow Jones Industrial Average, which is almost about 7% down. This index consists of 30 companies that are highly profitable businesses. The majority of them have competitive advantage. Majority of them have been around for a long time. Whenever you watch the news outside the US, they always talk about when basically they're talking about the US market, they always talk about the Dow Jones because of the reputation of these companies. So what I decided to do is to look at these 30 companies, find the ones that are Sharia compliant, and if they're Sharia compliant, then we're going to look at pick those basically out of the 30 companies, the ones that are Sharia compliant, and then see if they are investable or not. And that's what we're going to do today. To look at them, all of 30 of them in one go, it will be very difficult, especially only if we pick in those that are Sharia compliant. So what I'm going to do is I'm going to do 5 today, and then I'm going to do 5 another day. So I'm going to do 3 videos in general, okay? And then try to cover as many as I possibly can. So today is the part 1 of those videos. And the first company that we're going to look at is 3M. 3M is industrial. It's basically products include safety and industrials, transportation, electronics, healthcare, and consumer. Okay, if you ever bought, one of those post-it notes, you probably bought it from them. If you've got one of those N95, whatever masks and so on, they are the companies that make them. Okay. So they don't grow as fast as the other companies out there. They don't normally grow organically, meaning they do like to buy other businesses that have similar sort of products. So they basically acquire those companies and add it to their portfolio. So it's a huge company. It's been around for hundreds of years. The company is currently trading, or share price is currently $169 per share. But before, in fact, I want to talk about one more thing. Couple of the brothers, I think we've got a lot of new subscribers, right? And thank you very much for subscribing. If you haven't liked this video already, please just like it. It helps a lot of brothers and sisters to actually join the video, basically the community, so we can grow this, okay? So one of the things that they've asked me is just to kind of go through quickly what some of these things mean, because if you knew, none of these things will mean anything to you. So I'm going to do it very quickly just to kind of give you an overview, and I will do that as I go along in the other videos as well. So obviously the ticker is, I'm sure you know the ticker, the sector, the company name, and then the share price. PE basically gives us an idea of the price to earnings ratio. And what it does is it gives an idea of whether this company is overvalued, undervalued. Anything below 20 is perfect, okay? And then what you need to do is you compare it with another company or the sector generally. So in this situation, we're comparing it with sector, the industrial sector. And currently you can see it's 25.29, and then we're looking at PE of only 16. So this seems undervalued at the moment. Earnings per share and market cap are obviously linked. So this is basically how much they make in terms of per share wise, in terms of profit wise. Market cap is basically the total shares out there divided times by the share price, and that will give you the market cap. Then you've got annual dividend yield. So this is how much money they give you, okay, as a basically a shareholder. So 3.45 for this company. And then 5-year growth rate is basically how the last 5 years, how much they've grown that dividend. So it's about 7%. They have been paying their dividend or growing their dividend of 62 years in a row. Okay, 62 years, that's very long time. That's dividend kings. Then you've got payout ratio. This is how much after they've paid all the their free cash flow. Basically, they look at their free cash flow on how much of this money are they spending on paying you and me as a dividend. So right now it's 56. Basically what we 58, and normally what we're looking for is 60 and below. So it's perfect right now. Dividend safety is obviously comes from Simply Safe Dividends, okay, and then tells us basically it's up to 99%. So 75 is good. 75 is really good. Then you've got free cash flow here. So this is how much money they have right now in cash that they can, use to buy another company, pay you a dividend, buy back their shares, okay, pay debt or whatever they need to do. This is the money that's available to them. The beta tells us basically how volatile this stock is, okay, in comparison to the market. So if the market goes up whatever percent, does it actually follow the market or is it just below the market? Generally this company is below the market, so anything below 1 is good. Anything above 1, it's basically volatile, meaning if the market goes down 10%, it will don't go down 10% or even more. Okay, it doesn't follow the market. 1 will be perfect, but below 1 is even good. Above 1, it's fine. Basically it's volatile. Okay, and also the opposite is the same. If the markets are going up and up, basically these companies will go just fractionally up in comparison to the market. So current ratio is the debt. We're looking at the debt level. So does this company have enough money to pay off in the next 12 months their debt? If they have a debt, can they pay within the next 12 months? And the answer is yes, if it's above 1. If it's below 1, then that's a questionable. Then you've got profit margin. Okay, so profit margin is this. Okay, and I want to show you from Investopedia. So it's expressed as a percentage. Profit margin indicates how many cents of profit has been generated for each dollar of sale. So how much they've retained from each dollar of sale. That's basically what it is. Okay, then we've got the return on equity, which is again similar. So the return on equity is the measure of company's net income divided by this shareholder equity. It tells us the corporation's profitability and how efficient it generates this profit. It also basically gives us it's considered satisfactory based on the industry standard, though the ratio near long-term average of the 500 S&P 500 of around 14 is typically considered acceptable. So anything above 14% is actually good. Okay, and then this company actually has a profit margin of 16.75% and the return on equity of 42.24%, which is very, very high. Then future growth, this is the type of business that grows about 5%, 6%, 7% if you're very, very lucky, because they're very old. They're not very innovative. They buy other companies and so on. So the growth is very slow, but they do pay you very good dividend. They grow their business as well, generally, okay, organically, as well as obviously buying other businesses as well. According to Simply Wall Street, it is undervalued at the moment, 33.7% undervalued. And the price target is $262 per share. According to Morningstar, it's kind of similar story, but it's slightly cheaper. So fair valued, but it's $191 per share. And as we've seen before, the stock is right now below 170. So you still got a little bit upside if you were to purchase this company. Now, I own this business. At the moment, I'm down, but I'm actually adding to it as we speak. And then it's a buy at the moment. The second company that we're going to look at, okay, is the J&J. J&J is in the healthcare, consumer, whatever. They are doing a split very soon in the next 18 months where the consumer sector, okay, the consumer sector will be split out of the business. So basically, and currently they're trading $170 per share, PE of 21. In comparison to the sector, okay, they are slightly lower. EPS of $7.81, and then market cap of $443 billion. Dividends wise, you got 2.5%, 5-year growth rate of 6%, and then 58 years of paying that, increasing that dividend. Payout ratio is quite low, 42, which is nice. Dividend safety of 99. Why? Because they have $22.4610 billion in the bank to pay you dividends, to buy back shares, to do all sorts of things. Beta is quite low, count ratio is good, above 1, profit margin is perfect, return on equity is perfect, and then you look in future growth of about 6%. Again, they're a very old company, they grow organically as well as obviously acquisition and so on, but right now they are very, very, in terms of growth wise, I would expect this business maybe 7, 8, but at the moment that's fine. I'll take that. Overvalued, undervalued, in terms of is undervalued about 40% according to Simply Wall Street, according to Morningstar, fairly valued. And then you've got $167 per share target wise by the end of this year, and it's also a buy. And I'll be honest with you, this is one of the businesses that I absolutely love, because their product is not only the vaccine and all that stuff, right? But it's also consumer staples. It's stuff that we buy generally when we go to the shops, when we have a flu, when we need basically anything to do with hygiene, whatever, right? And they are predictable business. They have so much cash. They've been around for a long time. They're household names. This is the type of businesses that when you're creating your own portfolio, almost, make sure 80% of your portfolio is based on this type of solid businesses, and then you can have another 5% of this, 5% of that, maybe 2-3% of speculative, but majority of your portfolio should be based on this. That's at least what I'm trying to do anyway. Right, so the next company we're looking at is Intel. Intel, they had their earnings report released today. It doesn't look great. The future looks good, but the stock price is actually quite low. So Intel have recently spent about $20 billion building a new factory in America. They are growing. They are slightly behind in comparison to AMD and others, but I believe this business will come back sooner or later. Right now, am I a buyer? I don't know. Okay, I've been looking at it, and I'll keep saying to myself, is the price goes below 50, I might actually buy a few shares, and it is actually below 50 right now. So I'm going to look into it a little bit more, into their earnings report, see if there's anything that will convince me to buy this. Okay, they're in the semiconductor sector. As you can see, it's $48 per share right now. PE very, very low in comparison to the sector. EPS $5.15. Again, market cap of $216 billion business. Can you believe that? Right, annual dividend yield of 2.6. Again, while you're waiting for the price to appreciate, you can actually enjoy the dividend. 7% 5-year growth rate, and then you've got 22 years of basically increasing that dividend. Payout ratio very, very low. Why? Because they have $17 billion in the bank. And when you look at the dividend safety, 96%. Beta is very low. Count ratio, they have got plenty of cash. You're not worried about in terms of bankruptcy or anything like that in the near future. Profit margin of almost 27, return on equity almost 26. But future growth, this is where the basic red flag. Okay, so this year and the next couple of years and the next probably 3 years, you might not see massive growth in this business. But if you're willing to buy it now and forget about it, get your dividend while you wait, the price would appreciate and the business will come back. They'll build that factory and things will be fine. And if that's what you want to believe, then absolutely maybe worth looking into this business. They're undervalued at the moment, about almost 40% according to Simply Wall Street. And then target price of $84 per share. You're doubling your money basically, almost. Okay. And then you've got 22% discounted according to Morningstar, and $65 per share. That's what they're saying. It's definitely a buy for now. So the next company is we're looking at Nike, or Nike, whatever you want to call it. Again, there's been a little bit of boycott because of what's happening in China, but they came out recently, they talked about it, and I'm sure they don't want to get into that business. So I'm hoping that what they're saying is true. I don't own it yet. I'm going to wait for a little bit more news, but I just want to share with you. It's one of the companies in the Dow Jones Industrials average, and I'm going to talk about it. Okay, so current ratio, current price of $143 per share, PE of very, very expensive actually, for almost the 38, very expensive, even include basically in comparison to the sector. EPS $3.81, market cap of $239 billion, annual dividend of just below 1%, 12% of 5-year growth rate, and then dividend growth streak of almost 20 years, 19 years, whatever. Payout ratio quite low. Dividend safety absolutely perfect. That's the highest you can get. Free cash flow almost to 6.5% $1 billion in the bank to actually pay you the dividends and so on. Beta is quite low. Current ratio perfect because it's above 1. They can pay off their dividend and their debt within the next 12 months with no problems. Profit margin 13%, return on equity 48%, and future growth is about 15%, which is really good. And that's probably why a lot of people are paying high multiples for this stock. Okay, then you basically is overvalued at the moment according to this, 7%, overvalued according to Morningstar, 10%. Price target is 136, 132, currently 143. So it needs to go down at least maybe $20 or so for me to even look at this. Okay, and again, because of the situation that's happening in China, I'm not really comfortable yet, but I might look into it, do a little bit more research. And finally, the final company that we're going to look at is in the oil sector. The oil sector has been killing it, trust me. Even today, where everything, this basically year to date, where everything is down. Look at these companies. Look at Chevron and look at Exxon. Both of them 21% up, 13% up. Absolutely crazy. When you look at the energy sector, that's the only sector that's outperforming all the other sectors put together. Okay, on daily basis, this is what they've been doing, right? So Chevron is in the energy sector. They've got upstream and downstream, meaning basically they dig it, they do all the basically exploration, development, production of all of these crude oil and natural gases. They then take it and basically send it to whoever they need it to send it to. So from A to B, basically they do the whole thing. They currently have P of current price of $133 per share. When you look at the sector, their PE is actually quite high, which is basically one of the reasons why I wouldn't get into it right now. EPS $5, market cap $258 billion. Dividend very, very high, and I think their earnings report came out, or they've increased their dividends, I think by about 6% or 4% yesterday or today. One of them I just saw in the news today or something. 5-year growth rate of 4%, 33 years of dividend growth streak, payout ratio of 95. This is very high. Okay, although it's 65% safe. Okay, according to Simply Safe Dividend, again that's very, very high. Okay, and that's normal oil companies. Okay, there are some that really better, but oil companies tend to be they cut their dividends here and there basically. And when you look at their dividend streak though, for this listed for Chevron, it's 33 years of basically increasing that dividend. And then you've got free cash flow of $14.45 billion. Beta is quite low, current ratio above 1, so they have enough to pay their debt for the next 12 months. Profit margin very low, return on equity is almost terrible. Those two are very, very low in my opinion. And then future growth, so if you're basically buying the oil sector, you're only doing it for the dividend. And I genuinely thought about the dividends as well, because I just wanted that dividend compounding effect to kick off in my portfolio. And I thought maybe add a couple of stocks, but then when I saw this, I'm like, maybe now is not the right time, considering they trade in basically 25 multiples, which is just too high for me. Okay, undervalued at the moment, about 8%, fairly valued according to Morningstar, 143 target price, and then basically 128 price target, and it's a buy. Now this is also in the Dow Jones. That's one of the reasons we're looking at this. Now, those are the 5 companies that I want to share with you today. I will do another video where I will be sharing another 5, okay, in the next couple of days. The reason, like I said, I'm doing this is just to look at the quality companies that you could potentially add to your portfolio to make it, if you've got loads of speculative or basically high growth businesses, maybe it would not kill you to have some of those stable businesses that have a lower beta, predictable income, very well-known, companies and so on. And that will basically make your portfolio better when it comes to recession times, when it comes to down times like where we're at right now. So in the last couple of days, the stock market has been absolutely crazy. Look at this, just this week. Okay, so in those situations, you won't buy those high growth, whatever, that's fine. But at the same time, you want to look at the low basically companies that we talked about, the consumer staples sector, maybe energy, maybe other sectors. Okay, and every company that's in this sector, in this Dow Jones, is actually companies that have a basically good profit margins, and that's what we're looking for. Okay, because profit margins leads to having some sort of a cash in the bank, and that leads to some sort of a dividends, payback shares, all of that stuff. It helps the business actually grow faster. Right, let me stop talking. It's been a long video. I hope you enjoyed. If you're finding value in any of the videos that we've done, please just like those. Okay, just press the like button. I hope you enjoy your day. Assalamu Alaikum. Take care.